Hello, and welcome to McQuilling TV. I'm Claire Schmidt, and joining us again today is Conor Stone, Marine Transport Advisor at McQuilling Services. Welcome back, Conor.
Thanks for having me again, Claire.
I noticed that McQuilling Services has recently released its 2017 mid-year update, so congratulations on that.
Thank you.
In the document, you explain how the VLCC tanker demand has developed around the OPEC production cuts. Can you take a moment to explain this?
Yes, so we're projecting for the year that VLCC demand on the AG West trade is going to decline by about 12.2%. And this is on the basis of continued OPEC production cuts and higher U.S. production. Now looking at AG flows to the east, we've seen some pressure from OPEC production cuts, but volumes remain healthy as AG producers try to retain market share out to the east. And along this trade, we expect VLCC demand to increase by about 1.6% this year. Now moving to West Africa, we've seen an increase in production from Nigeria, which has placed some pricing pressure on grades there. And we've also seen some healthy flows of Angolan and Congolese crude to China. And so on that basis, we project that VLCC ton-mile demand from West Africa out to the east should expand by 7.6% this year.
So is this also what's driving the expansion of U.S. crude exports?
Yes, so the OPEC production cuts are supporting Middle Eastern crude pricing, and we've seen some pressure on WTI-linked grades from higher U.S. production and higher Canadian output, which is driving these Eastern refiners to source some of these barrels. As of right now, we're on track for 2017 to have about 40 VLCC cargoes out of the U.S. Gulf, with significant growth to the east. Actually, over our forecast period, we expect an annualized growth rate of about 1.5% on the U.S. Gulf to east route. And what we might see is a transitioning to Southeast Asia, and this is on the back of lower demand in Japan and Korea, as well as more Chinese crude remaining at home. Now, we've got to remember this is all in context of the OPEC production cuts, so if compliance starts to come down, we're likely going to see a reduction in U.S. crude out to the east. And while overall demand for the VLCC sector is expected to rise and remain strong this year, what's going to drive freight rates over the next few years is really the supply side. And we've seen a significant expansion in ordering this year, and our delivery schedule for the outer years of our forecast has expanded quite significantly. So freight rates are going to be slightly depressed on the back of this.
That's very interesting. Could you also touch on the Suezmax demand?
Yes, so the Suezmax sector as a whole is expected to expand by 5.8% in terms of ton-mile demand this year. What we're seeing is higher crude supply in the Mediterranean and Black Sea on the back of higher output from Libya, Kazakhstan, and redirected Russian barrels. So what's happening is you see some pricing pressure on this crude, which in a low freight rate environment incentivizes Eastern refiners to source these barrels. So for the Black Sea Mediterranean route out to the east, we expect Suezmax demand to expand about 80% this year. The issue with all this regional supply of crude is a lot of it is heading into the European refining system, which has put some pressure on West African barrels into Europe. And we've also seen more interest for VLCC cargoes out of West Africa into Europe, which pulls away from Suezmax demand. And this trade for Suezmax is expected to fall by about 10% this year. Now, where we're seeing some benefit for Suezmax is more interest in the Atlantic Basin to break down VLCC cargoes into smaller stem sizes, which may provide some support this year.
Great. Well, thanks so much, Conor, for coming back and talking to us again. We hope to have you back real soon.
Thanks. I'd love to come back.
I'm Claire Schmidt, and this has been another episode of McQuilling TV. Thanks for tuning in.